Did you know the rich actually use debt to build more wealth? Debt often has a negative association, but in this video, we'll explore various debt strategies the wealthy use to make even more money long term. Let's start by learning how the rich extract money from their assets without selling them. Strategy number 1. Borrowing against assets. An asset-backed loan is a type of loan that is secured by an asset. If the borrower fails to repay the loan, the lender has the right to seize the collateral and sell it to recoup their money. Let's go through a specific example of an asset-backed loan together. Suppose a wealthy individual is loaded to the gills with a portfolio of blue-chip stocks worth $10 million. She wants to invest $2 million in a new business venture, but doesn't want to sell her stocks and trigger capital gains taxes. Instead, she obtains an asset-backed loan using her stock portfolio as collateral, which the bank could sell if she fails to repay the loan. She secures a $2 million loan at a 3% interest rate, using her $10 million stock portfolio as collateral. She then utilizes the loan to invest in the new business, anticipating a 10% annual return. In the meantime, her stock portfolio continues to appreciate and generate dividends. This strategy greatly benefits her as it provides the needed cash without selling her stocks. Since she doesn't sell her stocks, she also bypasses capital gains taxes, which could be 20% or more, depending on her income level and the holding period. As her new business generates income, she can use this income to pay down the loan. Additionally, if her stocks absolutely rip to the moon, she might refinance her loan under more favorable terms, requiring less stock as collateral or reducing the interest rate. When she pays off the loan in full, her stocks will no longer be tied to the loan. Now, it's absolutely fine to sell assets from time to time, particularly if their future has turned to piss. But when it comes to pristine assets likely to continue growing long term, the rich tend to use tools like asset-backed loans to hold on to them at all costs. Let's move on to strategy number 2, buying stocks on margin. Investors can use margin accounts to buy stocks by borrowing money from a broker. This allows them to purchase more shares than they could with their own cash, potentially amplifying their returns. However, this strategy also comes with increased risk. Consider this example. Alex has $1 million of his own money invested in stocks. The market has just fallen 30%, presenting an opportunity for Alex to absolutely load up on cheap shares. His margin brokerage account allows him to buy up to $2 million worth of stocks, which is twice his equity. To take advantage of the market decline, Alex decides to use margin, or borrowed funds, to buy another $200,000 worth of stocks. After this purchase, Alex's total investment is $1.2 million. $1 million of his own equity, plus $200,000 borrowed on margin. If the market recovers by 20%, the value of his portfolio increases to $1.44 million. After repaying the $200,000 loan by selling $200K of his stocks, excluding interest for simplicity, his net portfolio value is $1.24 million. This results in a net gain of $240,000, which represents a 24% return versus the 20% return in the market. However, this strategy also increases risk. If the market continues to fall, Alex's losses will be magnified by 20% since he increased his stock allocation by 20% with borrowed money. This is why Alex didn't go full degen mode and use up all $1 million of his available margin. It's wise to use only a small portion of your maximum margin to give yourself room to be wrong. Lastly, borrowing on margin incurs interest costs, which can stack up over time. And there's the risk of a margin call if the value of your equity takes an absolute I'd say this strategy should only be used during the most opportunistic of times. Strategy number 3, borrow low and invest high. This strategy involves taking out a loan at a low interest rate and investing the borrowed money in an asset that yields a higher return. Imagine Sarah, a wealthy investor, notices that she can borrow money at a 4% interest rate. She decides to take out a $1 million loan from her bank at this low rate. Sarah then invests this $1 million in an asset she believes will appreciate by 10% or more over the coming year. Sarah isn't a plonker. She knows right what she's doing, and her investment thesis holds true, generating 12% or $120,000 over the following year. Meanwhile, she pays $40,000 in interest on the loan. The difference between her investment income and the interest cost is $80,000. By borrowing at a low rate and investing in a higher-yielding asset, Sarah effectively leverages her access to cheap capital to generate additional income. Strategy number 4. Using mortgages to buy real estate. Emma has saved up $1 million and wants to invest in a charming, posh rental property worth a cool milli. Instead of splashing all her cash, Emma takes out a mortgage for $800,000 at a 4% interest rate, using her $200,000 as a down payment. The rental property brings in $60,000 annually. Emma's annual mortgage payments, at a simple 4% interest rate, amount to $32,000. After paying the mortgage, she nets $28,000. On top of that, the property appreciates at an average rate of 3% per year, adding another $30,000 to its value annually. Absolutely brilliant. Between the rental income and the property's appreciation, Emma's looking at an extra $58,000 a year. With an initial investment of $200,000 and an income generation of $58,000, Emma achieves a 29% return on her allocation. Good golly. By leveraging debt via a mortgage, Emma can revel in the benefits of rental income and property appreciation, while only paying a small portion of the property's value up front, significantly juicing her wealth over time. Cheerio to that. Strategy number 5. Debt refinancing. Financially savvy individuals use debt refinancing to slash their monthly interest expenses. Consider James, who has a $1 million loan at a 7% interest rate, with annual payments of $70,000. Interest rates decline over the years, allowing James to refinance his debt. He gets approved to refinance his loan to a 3% interest rate, reducing his annual interest expense to $30,000. By refinancing, James frees up $40,000 a year. Instead of this cash getting incinerated by higher interest expenses, James frees up that cash and smashes it into Bitcoin, digital property that has generated a minimum 24% annualized return over 4-year holding periods. Over a year, Bitcoin rips a hole in the sky and rockets 40%, growing his $40,000 investment into 56,000 green ones. This refinancing move not only reduced his annual interest expense by $40K, but also allowed him to reinvest the savings and generate another $16K in gains, thereby causing his wealth to bulge massively, and he's totally stoked to the max about it. Now hold your horses. Don't dash off and pile up debt just because you've listened to this chat. The key to debt strategies is that the return on investment exceeds the interest on the debt. This is why credit card debt is trash, as the interest rate is often upwards of 20% per year, compounding faster than most assets. And credit cards are used to buy things that generate absolutely no returns. The wealthy only use debt when they are confident they can cover the interest payments and generate returns in excess of the interest. My friends, consider subscribing and saying hello in the comments below. My name is Wealthmore, and I hope to see you in this next one.